If the 20th century was the age of steel and oil, then the 21st century has become the age of data and technology. Wealth no longer depends solely on factories or land. It is increasingly shaped by algorithms, code, and networks. In this shifting world, opportunities to grow money appear to be everywhere. With a few taps on a smartphone, an investor can buy shares in a multinational company, purchase cryptocurrency tokens, lend to a startup on a crowdfunding platform, or even own a slice of digital art through NFTs. The borders of finance have dissolved, and the world feels like a giant marketplace open 24 hours a day. Yet with this abundance of possibility comes an equally powerful wave of risk, and too often the bright promise of easy gains fades into the sobering reality of sudden losses. Picture this. A man in his 40s sits in his living room in Chicago. He opens a trading app and buys cryptocurrency late at night after reading a glowing post online. The next morning, the value has fallen by half. In contrast, his neighbor down the street quietly invests in a diversified retirement fund and forgets about it for years. 10 years later, the neighbor enjoys steady growth, while the first man looks back at a trail of frantic trades and missed opportunities. This contrast is not unique. It repeats itself across the globe every day. The digital age has made access to investing incredibly easy, but it has not changed the fundamental truth that markets reward wisdom and patience more than emotion and haste. As we enter this story together, let's pause. If you are listening right now, I invite you to share in the comments where you are watching from and what time of day it is. Are you relaxing at night or listening during a morning commute? And while you are here, remember to subscribe to AudioBook Sanctuary and turn on notifications so you never miss future journeys like this one. We are building a community of thoughtful listeners, and your presence matters. Now, let us return to our exploration. The digital investment landscape is vast, like an ocean with countless vessels setting sail. Some are small boats, individuals trading crypto from their phones. Others are massive ships, hedge funds and institutional investors deploying billions with high-frequency algorithms. But no matter the size of the vessel, the sea itself remains unpredictable. Storms appear suddenly. Tides change direction. The very technology that empowers also destabilizes. For every story of someone who made a fortune overnight, there are countless others who lost savings in the blink of an eye. Consider the rise of Bitcoin. In 2010, a programmer paid 10,000 Bitcoins for 2 pizzas. At the time, the value was trivial. A decade later, those same coins were worth hundreds of millions of dollars. Stories like this ignite dreams of getting rich quickly. Yet few mention the investors who bought at the peak of a frenzy, only to watch values collapse. The lesson is not that Bitcoin or digital assets are inherently bad, but that the psychology of investors often swings between greed and fear, amplifying volatility. Real estate, long considered a stable foundation, also faces digital transformation. Platforms now allow fractional ownership, where an investor can buy a piece of property without ever visiting the site. Artificial intelligence predicts rental demand, while virtual tours sell homes across continents. At the same time, digital illusions can hide structural flaws, and algorithms can misjudge human behavior. The traditional sense of knowing the land is fading, replaced by trusting digital dashboards. Stock markets, once reserved for brokers on crowded exchange floors, are now accessible through sleek apps with colorful charts. A teenager in Vietnam can invest in the same companies as a professional in New York. Barriers have fallen, but so too has the protective distance that once forced investors to pause and consider. The swipe of a finger can now move thousands of dollars, encouraging impulsive decisions. This democratization is both beautiful and dangerous. And then there is the surge of fintech, companies blending finance with technology. Peer-to-peer lending platforms allow individuals to bypass banks. Robo-advisors build portfolios automatically. Payment systems like PayPal, Venmo, and mobile wallets turn transactions into digital flows that can be tracked and analyzed in real time. These innovations expand access, but they also blur lines between investing, spending, and speculating. What emerges is a paradox. Never before has it been easier to invest, yet never before has it been easier to make costly mistakes. The noise of digital culture, tweets, viral videos, online forums, often drowns out the steady voice of prudence. Investors are seduced by promises of doubling wealth overnight, forgetting that genuine prosperity grows more like a tree than like a firework. The story of the dot-com bubble in the late 1990s is a powerful reminder. Companies with no profits but flashy websites attracted billions in capital. Share prices soared. Then, almost overnight, the illusion shattered, wiping out fortunes. Yet from that rubble, genuine innovators like Amazon and Google rose, proving that while bubbles burst, true value endures. The same pattern repeats in every age. The challenge for today's digital investor is to tell the difference between smoke and substance, between a fleeting craze and a lasting opportunity. Technology itself is not the villain. It is a tool. A sharp blade can cut fruit or cause injury depending on the hand that wields it. In the same way, apps, algorithms, and AI can amplify wisdom if guided by discipline, or magnify folly if driven by greed. The deciding factor is not the technology, but the mindset of the investor. This is why our journey in this audiobook does not aim to hand you a secret formula or a guaranteed shortcut. Instead, it offers a compass, principles, and perspectives that remain steady while the world shifts. Think of it as learning to navigate by the stars, rather than by the glow of temporary fireworks. As we close this first section, remember this image. The digital investment world is like a vast ocean at night. Some vessels chase after every glimmer of light, mistaking it for safe harbor. Others steer steadily by the stars, trusting ancient patterns that have guided sailors for centuries. Which path will you choose? And so, as we move forward, we will dive deeper into the timeless principles of wealth, those unchanging stars that shine above the stormy sea of technology. The ocean of modern investing may look new, but the stars guiding us have always been the same. Technology changes, industries rise and fall, but the principles of wise wealth building endure. Think of them as the bedrock beneath shifting sands, steady, unyielding, and reliable even as waves crash overhead. To understand how to survive and thrive in the digital era, one must first return to these timeless rules, the lighthouses that keep ships from wrecking against unseen rocks. The first of these is diversification. Imagine a farmer who plants only one crop across his land. If a drought comes or pests invade, his entire harvest is ruined. Another farmer, wiser and more patient, plants a variety of crops. Some may wither, but others flourish, ensuring he always has enough to survive and grow. Investing is no different. Diversification means spreading resources across asset classes, industries, and geographies. Stocks may fall while bonds rise. Real estate may stagnate while commodities surge. No one can predict the future with certainty, but diversification acknowledges human limitation and builds resilience against surprise. The 2008 financial crisis offered a painful lesson. Many investors held portfolios heavily tied to real estate or mortgage-backed securities. When housing markets collapsed, so did their fortunes. Those who had diversified across international equities, cash reserves, and safer bonds endured the storm with fewer losses. It was not luck, it was discipline. Diversification is not glamorous, but it is a shield. The second principle is the long-term horizon. In a world obsessed with instant gratification, this principle feels almost countercultural. Yet history speaks clearly. Markets reward those who think in decades, not days. Warren Buffett once said, "Our favorite holding period is forever." His philosophy is not about timing the market, but about time in the market. Over the long arc, despite wars, recessions, and crashes, broad markets tend to rise, reflecting the growth of human productivity and innovation. Consider the story of Grace Groner, a woman who worked as a secretary for Abbott Laboratories in Illinois. In 1935, she bought 3 shares of the company for $180. Instead of selling when times were hard or chasing new trends, she simply held on, reinvesting dividends. By the time she died decades later, those shares had multiplied into a fortune of over $7 million. Grace never chased the noise of markets. She trusted time, patience, and compounding. Compounding itself is the third principle, closely tied to the long-term view. Albert Einstein once called compounding the 8th wonder of the world. When earnings are reinvested, they generate their own earnings, creating exponential growth over time. A single dollar, wisely invested, can blossom into a forest if left undisturbed. The tragedy of many modern investors is that they uproot their seeds too soon, hoping to replant elsewhere for quicker growth, only to end up with barren soil. Yet holding too long without judgment can also be dangerous. This is where the principle of risk management enters. Risk cannot be eliminated, but it can be understood, measured, and contained. Risk management is like the sailor's awareness of storms. He cannot control the weather, but he can choose a stronger vessel, avoid dangerous waters, and carry life rafts. Investors manage risk by setting stop-loss points, avoiding over-leveraging, and recognizing their tolerance for volatility. Think of the story of long-term capital management, a hedge fund in the 1990s led by Nobel Prize-winning economists. Armed with sophisticated mathematical models, they believed they had conquered risk. They leveraged their positions dozens of times, confident their formulas would protect them. But when markets moved in unexpected ways during the 1998 Russian financial crisis, the firm imploded, threatening global collapse. Intelligence and technology were not enough. Humility and caution were missing. Humility is itself a hidden principle. The greatest investors admit what they do not know. They accept uncertainty as part of the journey. Benjamin Graham, the father of value investing, emphasized the concept of a margin of safety, always leaving room for error. Just as architects design bridges to carry far more weight than expected, wise investors build portfolios that can withstand shocks greater than predicted. The final principle is emotional discipline. Perhaps this is the hardest, for it requires mastering the self rather than the market. Greed in times of boom and fear in times of crash are the twin enemies of wealth. Jesse Livermore, a legendary trader of the early 20th century, made and lost several fortunes because he could not restrain his impulses. In contrast, Buffett, Graham, and other patient investors built steady fortunes not by outsmarting everyone else, but by refusing to be ruled by emotion. These principles, diversification, long-term perspective, compounding, risk management, humility, and emotional discipline, are not glamorous. They do not promise overnight riches. They do not go viral on social media, but they form the backbone of real and lasting prosperity. In a sense, they are like the laws of gravity. You may ignore them, but you cannot escape them. Now, why do these rules matter more than ever in the digital age? Because technology accelerates everything. Decisions are made faster, trends spread wider, and volatility strikes harder. In such an environment, timeless principles are not outdated, they are essential. They act as anchors, holding steady when waves of information threaten to sweep investors into panic or frenzy. Picture two sailors setting out into a digital storm. One clings to every new app, every trending stock tip, chasing light after light in the dark. The other holds fast to his compass, trusting principles that have guided sailors for centuries. The storm is the same, but the outcome is not. The first is tossed helplessly. The second sails with steady direction. As we move from here, keep these principles in mind, for they will serve as the foundation upon which we compare the old world of investing with the new. For while the tools may look different, trading floors versus mobile apps, paper ledgers versus blockchain, the underlying currents of human behavior remain surprisingly similar. The world of investing may look entirely transformed in the 21st century, yet beneath the surface there are echoes of the past. Traditional forms of investing, stocks, bonds, real estate, once seemed like the solid pillars of wealth. Now, new digital avenues, cryptocurrencies, NFTs, fintech platforms, shine with the allure of speed and innovation. But though the vehicles differ, the forces driving them are often the same: hope, fear, discipline, and greed. To understand how to be wise in the digital era, we must compare what has always been with what is emerging, seeing both the similarities and the profound differences. Picture the New York Stock Exchange a century ago. Crowded floors, men in suits shouting orders, paper tickets flying through the air. It was noisy, chaotic, and yet built upon systems of regulation, transparency, and centuries of evolution. Now imagine a teenager in her bedroom in California, tapping a phone screen to buy a fractional share of Apple stock within seconds. The process is silent, frictionless, and instant. At first glance, these worlds could not be further apart, yet both depend on the same principle: ownership of a productive asset that creates value over time. Traditional investing in stocks has long relied on analyzing business fundamentals, profits, assets, market demand. Real estate has been grounded in tangible reality: land, buildings, location. Bonds, though less glamorous, represent trust in governments or corporations to repay borrowed money. Each of these carried risks, but they were risks connected to real productivity and assets. They moved with the cycles of economies and societies, not simply with online chatter. In contrast, digital investments often move at the speed of emotion rather than the pace of production. Cryptocurrencies can rise or fall 20% in a single day based on tweets or headlines. NFTs, digital certificates of ownership for art, music, or even memes, can sell for millions one month and become nearly worthless the next. The volatility is breathtaking, and while it attracts thrill seekers, it can devastate those who confuse speculation with investment. And yet, it would be a mistake to dismiss digital investments entirely as illusions. Just as the internet in the 1990s seemed like a fad to some, but later birthed trillion-dollar companies, blockchain and fintech may well produce tomorrow's giants. The key is recognizing the difference between a bubble fueled by hype and an innovation that genuinely solves problems. Amazon survived the dot-com crash because it built real value. Thousands of other companies vanished because they did not. The same pattern will separate lasting digital innovations from temporary frenzies. There are also striking similarities between traditional and digital investing. Human psychology has not changed. In the 1929 stock market crash, crowds panicked, selling in waves and deepening the collapse. In the 2021 crypto crash, the same herd behavior played out, magnified by social media. The tools are new, but the emotions are ancient. Greed drives bubbles. Fear fuels crashes. Discipline creates resilience. The differences, however, are critical. Traditional investments often require intermediaries, banks, brokers, regulators, that slow decisions and enforce standards. Digital platforms remove these barriers. This democratization empowers ordinary people, but also exposes them to scams, manipulation, and extreme risk. A person can now open a trading account in minutes and gamble life savings on leveraged crypto positions without ever speaking to an advisor. The speed of access multiplies the speed of mistakes. Another difference lies in transparency. Public companies must disclose earnings, risks, and governance. Real estate deeds are registered with governments. Bonds are issued with legal obligations. In contrast, many digital assets are unregulated, with anonymous founders and opaque operations. Investors are often left trusting white papers or online communities rather than audited statements. Trust becomes fragile, and when it collapses, so does value. Still, digital investing offers undeniable advantages. Lower barriers mean a broader range of people can participate in wealth building. Fintech tools automate diversification and make sophisticated strategies accessible to small investors. Blockchain promises faster, cheaper transactions with global reach. These are powerful shifts, much like when stock markets themselves were first created centuries ago. To reject them entirely would be like refusing to use electricity in the early 1900s. The wiser approach is integration, learning from the reliability of traditional investing while embracing the efficiency of the digital. A modern investor might hold real estate and index funds for stability, while cautiously exploring blockchain or fintech opportunities for growth. This balance mirrors the dual nature of our era, rooted in history, reaching toward the future. Let us recall one more story. In the 17th century, Dutch merchants speculated wildly on tulip bulbs, driving prices higher than the cost of houses. When the bubble burst, many were ruined. Today, NFTs and meme coins echo that frenzy. But just as tulips remained beautiful flowers, blockchain remains a powerful technology. The flower was real. The frenzy was not. The same distinction must guide us now. As we conclude this section, remember this: traditional investing and digital investing are not enemies but reflections of the same human pursuit, turning today's resources into tomorrow's security. The question is not whether one will replace the other, but how wisely we will weave them together. And as we move forward, we must learn how to spot which opportunities are genuine and which are bubbles waiting to burst. Every age of investing has carried both promise and peril. But perhaps never before has the line between opportunity and illusion been so thin. In the digital world, a single headline, a viral post, or a celebrity endorsement can turn an obscure asset into a frenzy overnight. Yet just as quickly, fortunes can evaporate. To be a wise investor today is to cultivate the ability to tell the difference between genuine opportunity and speculative bubbles. Imagine standing in a crowded marketplace centuries ago. Merchants cry out, each promising that their wares will bring prosperity. Some sell fine silk, sturdy tools, and salt that will preserve food for months. Others wave trinkets, glittering under the sun but worthless once carried home. The marketplace of the 21st century is much the same, only now it is online, global, and amplified 1,000-fold by social media. The challenge is still the same: how to separate lasting value from empty promises. History is a patient teacher. In the early 1600s, the Dutch Republic experienced what we now call tulip mania. At its height, the price of a single tulip bulb equaled the cost of a fine house in Amsterdam. People sold land, livestock, and even family heirlooms to buy bulbs, convinced they could sell them for more tomorrow. But when buyers disappeared, prices collapsed almost overnight, leaving devastation behind. The lesson is clear. When the price of something rises solely because others believe it will, rather than because it creates lasting value, danger is near. Centuries later, the same pattern reappeared in the dot-com bubble of the late 1990s. Investors poured money into internet companies with little more than a website and a dream. Stock prices soared without profits, fueled by the conviction that the internet would change everything. Indeed, the internet did transform the world, but only companies with real business models survived. Amazon and eBay grew into giants, while thousands of others vanished. Once again, the difference between substance and speculation became brutally clear. Fast forward to recent years, and we see echoes of both tulips and dot-coms in the world of cryptocurrency and NFTs. At the peak of cryptomania, new coins launched daily, some created as jokes, others with elaborate promises. NFTs of digital art sold for millions, often fueled by hype rather than intrinsic worth. Many who bought late in the frenzy now hold assets worth only a fraction of their purchase price. And yet, just as with past bubbles, the underlying technology, blockchain, remains powerful and full of potential. The frenzy fades, but innovation persists. So how does one spot the difference? There are guiding questions that act like lanterns in the fog. Does the investment solve a real problem? Does it create value independent of price speculation? Can its worth be measured in productivity, service, or utility rather than in hopes alone? If the answer is no, then caution is wise. True opportunity often appears less glamorous. A stable dividend-paying company reinvesting in its growth rarely makes headlines, yet it can quietly build fortunes over decades. A well-located rental property may not double overnight, but it provides shelter, income, and tangible value. Even in the digital realm, some blockchain projects are solving real challenges, such as secure record-keeping, supply chain transparency, or faster international payments. These may not spark the loudest hype, but they stand on stronger foundations. To sharpen this skill of discernment, it helps to remember that human psychology often betrays us. Greed whispers, "Everyone else is getting rich. You must join now." Fear hisses, "Sell everything before it's too late." Both voices cloud judgment. The wise investor learns to step back, asking, "Would I still invest in this if no one else were talking about it? Does it have value in 10 years, not just tomorrow?" Take the story of Sir Isaac Newton, one of history's greatest minds. In 1720, he invested in the South Sea Company, a stock that was soaring at the time. Initially cautious, Newton sold early for a profit. But as he watched others grow richer, he re-entered at a higher price, swept up in the frenzy. When the bubble burst, he lost much of his fortune. Newton later lamented, "I can calculate the motions of heavenly bodies, but not the madness of men." His brilliance could not overcome herd behavior. In our era, the herd is louder than ever. Social platforms magnify every wave of enthusiasm and panic. A meme can spark billions in trades. A rumor can crash markets within minutes. The investor who survives is not the one who runs fastest with the crowd, but the one who recognizes when the crowd is running toward a cliff. This ability to distinguish opportunity from bubble is not about avoiding all risk. Every genuine opportunity carries uncertainty. It is about grounding risk in reality. A new technology may be risky but still worthwhile if it addresses a true need. A bubble, by contrast, is built on nothing but collective belief. When belief fades, nothing remains. As you listen to these stories and principles, imagine yourself as a lighthouse keeper watching the horizon. Lights flicker everywhere, some from sturdy ships, others from drifting debris. Your task is to know which signals to trust, guiding your course by steady beams rather than chasing every flash. And so, as we prepare to move forward, keep this truth close. Bubbles will always come and go, but genuine opportunities endure. The challenge is not to predict every wave, but to stand firm on principles that help you discern. For in the next stage of our journey, we will turn to those who have proven this wisdom. Legendary investors who built wealth not through frenzy, but through patience, discipline, and clarity of vision. Through every cycle of speculation and every storm of uncertainty, there have been individuals who navigated markets with a steadiness that seemed almost otherworldly. They did not rely on luck or chase after every new trend. Instead, they grounded themselves in timeless principles, discipline, patience, and clarity of thought. To understand what it means to invest wisely in the digital age, it helps to walk alongside these giants of history, learning not only their strategies, but their mindset. Consider Warren Buffett, often called the Oracle of Omaha. While millions rushed into internet stocks during the dot-com bubble, Buffett refused, stating simply that he did not understand how many of those companies would earn money. Critics mocked him for being old-fashioned, saying he had missed the future. Yet when the bubble burst, Buffett's caution proved his strength. His approach was never about predicting fads, but about holding businesses with real value for the long run. To this day, his portfolio thrives not because he moves quickly, but because he moves wisely. Another figure, Benjamin Graham, known as the father of value investing, taught a principle that remains critical. Always insist on a margin of safety. This meant buying investments at prices below their true worth, leaving room for error and uncertainty. Graham compared investing to weighing a business like a scale, focusing on its actual earnings and assets rather than market mood swings. His teachings shaped Buffett and countless others. In an era of instant digital trades, Graham's wisdom is a reminder that patience and analysis often triumph over speed and impulse. There is also the story of John Bogle, the founder of Vanguard and pioneer of index funds. Bogle believed most investors would fail trying to beat the market, especially as costs and mistakes piled up. Instead, he offered a simple path. Buy and hold a broad basket of stocks at low cost, letting compounding work over decades. At first, Wall Street laughed at the idea, but today, index funds represent trillions of dollars worldwide, and millions of ordinary investors enjoy steady growth thanks to his vision. Bogle's lesson was humility, accepting that one cannot always outsmart the market, but one can still succeed through consistency. From a different corner of history, consider Charlie Munger, Buffett's longtime partner. Munger often spoke of the importance of temperament. Intelligence alone was not enough. What mattered most was the ability to avoid stupidity, resist envy, and control emotion. He called it the discipline of inverting, asking not only, "What will make me rich?" but also, "What mistakes will ruin me?" In a digital world where every platform tempts us to chase returns, Munger's reminder is crucial. Avoiding folly is just as powerful as seeking brilliance. Not all lessons come from triumphs. Jesse Livermore, a legendary trader in the early 20th century, made and lost several fortunes. He was a master of reading market patterns and once profited enormously during the 1929 crash by short selling. Yet his inability to control his impulses led to repeated downfalls. His story is a warning. Skill without discipline can destroy as quickly as it builds. In a time when apps allow instant trades with leverage, his cautionary tale feels more relevant than ever. What unites these stories is not a single strategy, but a way of thinking. Great investors respect the unpredictability of markets. They understand that no formula guarantees success. Instead, they practice consistency, guard against emotion, and remain grounded in reality. They do not mistake luck for wisdom, nor do they chase validation from the crowd. In the digital age, surrounded by hype and noise, these lessons are like oxygen. A flashy coin or startup might promise riches overnight, but the steady example of Graham, Buffett, Bogle, and Munger reminds us that wealth is usually the product of years, even decades, of careful stewardship. The temptation is to believe that technology has changed the rules. In truth, technology only amplifies the stakes. Emotional discipline, patience, and prudence are more valuable than ever. Think of investing as planting an orchard. The impatient investor demands fruit immediately, tearing up trees when they do not produce fast enough. The wise investor tends the soil, waters faithfully, and waits through seasons. In time, the orchard grows strong, bearing fruit year after year. Buffett's orchard is Berkshire Hathaway. Bogle's orchard is the index fund. Your orchard might be a mix of traditional and digital assets, cultivated with the same patience. As this audiobook continues, let us take these lessons forward. The wisdom of those who walked before us is not a relic, but a living guide. For while technology adds new tools, the human heart still beats with the same emotions of greed and fear. To master investing is not to master algorithms, but to master oneself. And so we turn next to the tools of our own era: fintech, artificial intelligence, and data-driven platforms. These tools promise to reshape investing in ways our predecessors never imagined. Yet the question remains: will they make us wiser, or simply magnify our mistakes? The future of investing is being rewritten by machines, code, and platforms that previous generations could scarcely imagine. Where once investors studied balance sheets and paper reports, today algorithms digest millions of data points in seconds. Where once meetings with brokers or bankers were required, today a simple app can execute complex trades at the tap of a finger. These new tools of the digital age, fintech, artificial intelligence, and big data, are reshaping the landscape. Yet like every tool, they are double-edged. In the right hands, they empower. In careless hands, they can destroy. Fintech, short for financial technology, is the most visible face of this revolution. Think of services like PayPal, Venmo, or Stripe, which make transferring money instant across the globe. Peer-to-peer lending platforms allow ordinary people to fund each other's businesses without a bank in sight. Robo-advisors build personalized investment portfolios automatically, often at a fraction of the cost of traditional advisors. Fintech has lowered barriers, democratized finance, and brought millions of new participants into investing. But with accessibility comes temptation. A person who once needed to sit down with an advisor before moving retirement savings can now risk everything in high-volatility assets within seconds. Just as the printing press spread knowledge but also misinformation, fintech spreads both opportunity and risk. The wise investor uses it as a bridge to better decisions, not a gambling machine. Artificial intelligence adds another layer. AI can scan markets, detect patterns invisible to human eyes, and even forecast probabilities of movement with startling accuracy. Hedge funds have employed AI-driven trading systems for years, but now smaller investors also access these tools. Imagine a system that monitors your portfolio around the clock, alerting you to risks or rebalancing automatically. AI is like a telescope pointed at the sky of finance. It reveals constellations hidden from the naked eye. Yet telescopes can also mislead if the stars themselves shift. AI is only as good as the data it consumes and the assumptions behind its models. In 2010, a flash crash saw markets plunge nearly 1,000 points within minutes, partly fueled by automated trading systems spiraling out of control. Algorithms do not feel fear or greed, but they can amplify human folly at lightning speed. For this reason, the investor must remember that AI is a servant, not a master. It offers insight, but it does not replace judgment. Big data is the silent giant powering much of this world. Every online purchase, social media post, and digital transaction becomes a data point. Companies analyze these oceans of information to forecast consumer behavior, predict trends, and guide investment decisions. For example, satellite images of retail parking lots can reveal whether a store chain is thriving or declining long before earnings are reported. Credit card data can hint at consumer spending patterns. These signals give investors edges that were once unimaginable. But data can also overwhelm. With so much information available, the risk is mistaking noise for wisdom. A single unusual trend might spark premature conclusions, leading to costly errors. Moreover, questions of privacy and ethics loom large. Investors must ask not only, is this data useful, but also, should it be used in this way? Consider how these tools interact. A fintech app might offer you instant access to fractional shares. AI might analyze your portfolio and suggest trades. Big data might feed both systems with real-time insights. Together, they create a powerful ecosystem where an ordinary investor wields tools once reserved for elite institutions. Yet the danger remains. Having powerful tools does not automatically mean making wise choices. A child with a racing car still needs to learn how to drive. History offers warnings here too. In the early days of online trading, many believed technology itself guaranteed success. But during the dot-com crash, the very platforms that made trading easy also enabled reckless speculation. Similarly, during the rise of meme stocks in 2021, digital apps allowed millions to coordinate rapid buys of companies like GameStop. While some profited, many entered late and suffered heavy losses. Technology magnified both triumph and tragedy. The key lesson is balance. Embrace the efficiency of fintech, the insight of AI, and the foresight of big data, but never surrender judgment. Ask, does this tool help me make clearer decisions? Or is it simply making it easier for me to act impulsively? Am I using technology to serve my goals, or am I being used by it to serve someone else's profit? Imagine standing in a workshop filled with gleaming tools, hammers, saws, and machines. A master craftsman chooses carefully, respecting each tool's power and limitation. An apprentice grabs whatever is nearest, often injuring himself in the process. The digital investor must learn to be the craftsman, not the apprentice. As we close this section, remember that technology is not destiny. It is possibility. Fintech, AI, and big data can transform your investing journey, but only if guided by timeless principles. Without discipline, they magnify mistakes. With discipline, they amplify wisdom. And so, as we move to the final stage of this audiobook, we will return to the heart of the matter. Though technology evolves at breathtaking speed, the core truths of investing remain unchanged. Let us explore how unchanging wisdom anchors us in a changing world. Technology dazzles us with its speed and power. Markets rise and fall faster than ever. Fortunes are made and lost in a single week. And platforms promise instant access to opportunities across the globe. Yet beneath all this noise lies a truth as old as trade itself. Wise investing has never been about chasing what glitters. It has always been about patience, prudence, and principle. As we arrive at the final stretch of this journey, it is time to weave together the threads. Because while the digital age feels unprecedented, the essence of investing has not changed. Think of a river. It twists, turns, floods, and dries. But its flow is shaped by the same gravity that has existed for eons. So too with investing. The tools may evolve, from ticker tape machines to mobile apps, from ledgers to blockchains. But the gravitational pull of human behavior remains. Greed pulls people toward frenzy. Fear drags them into panic. Discipline, like gravity, keeps them grounded. Consider again Warren Buffett, who resisted the siren call of internet stocks in the late 1990s. His restraint looked foolish in the moment, yet wisdom revealed itself over time. Or John Bogle, who built index funds not because they were glamorous, but because they quietly compounded wealth. Their choices remind us that successful investing is not about chasing every wave, but about learning which ones to ride and which ones to let pass. The digital era tempts us to believe that principles no longer matter. This time is different, the crowd insists. Yet history whispers back, it is never different. Every bubble, from tulips to dot-coms to meme stocks, follows the same cycle of euphoria and collapse. Every lasting success, from real estate empires to long-term portfolios, grows from the same soil. Discipline, patience, and respect for risk. Even as artificial intelligence grows sharper, even as fintech reshapes access, the wise investor remains steady. Technology can guide, but it cannot replace judgment. Algorithms can predict probabilities, but they cannot quiet fear when markets plunge or greed when prices soar. That is the work of the human spirit, your spirit as an investor. Imagine two captains at sea. One has the most advanced ship ever built, with radar, GPS, and automated sails. The other has an older vessel but carries charts, compass, and decades of seamanship. When a storm arrives, it is not the ship alone that determines survival, but the captain's skill. In the same way, your future as an investor will be shaped not only by the tools in your hand, but by the wisdom in your mind. So what is the call to action for us, living in this fast-changing world? It is to embrace technology without surrendering to it. Use fintech for access, AI for insight, and data for clarity, but anchor yourself in timeless rules. Diversify your holdings. Think long-term, protect against risk, and never let emotion dictate your moves. These are the true compass points of investing, guiding across every storm. You cannot control the market any more than you can control the weather. Prices will rise and fall. Bubbles will inflate and burst. New technologies will dazzle and fade. But you can control your response. You can choose patience over panic, prudence over speculation, wisdom over noise. That choice, repeated steadily over years, is what builds lasting wealth. As you close your eyes and let these words settle, remember, investing is not a race against others, but a lifelong journey of stewardship. You are not simply growing money. You are shaping a future, protecting your family, and planting seeds for generations. Technology will continue to evolve. Blockchain, metaverse, quantum computing, tools yet unimagined. But the true investor's power remains unchanged. discipline, humility, and vision. These are the constants in a world of flux. And so, let us conclude with this thought. You cannot command the storm, but you can become a steady sailor. In the digital age, where markets roar and screens flash, the wisest path is still the oldest one. Steer by principle, not by hype. Anchor yourself in patience, not in panic. And trust that while the tools of tomorrow may change, the heart of wise investing will always remain. The journey we have taken through this audiobook has carried us from crowded trading floors of the past to the glowing screens of the present. We have walked among tulip merchants in 17th century Amsterdam, speculators in the roaring 1920s, and crypto enthusiasts in online forums. We have listened to the wisdom of Buffett, Graham, Bogle, and Munger, and we have explored the promise and peril of AI, fintech, and big data. Through it all, one truth has remained steady. Technology may change, but the essence of investing does not. The tools in your hand today are powerful. With a smartphone, you can do what once required a team of bankers and analysts. You can buy shares, trade crypto, analyze data, and move capital across the globe in seconds. But power without principle is dangerous. The same app that gives you opportunity can also tempt you into ruin. That is why timeless principles, diversification, long-term vision, risk management, and emotional discipline remain the foundation upon which all wealth is built. Think of bubbles. They always begin with excitement, grow through greed, and end in fear. Yet in their ashes, genuine value often emerges. The internet bubble birthed Amazon and Google. The frenzy over blockchain may yet yield lasting revolutions in finance and security. The wise investor does not fear bubbles but learns from them, recognizing that opportunity and risk are inseparable twins. What then is your task in this era? It is to become a steward, not a gambler. To use technology not as a lure for quick riches, but as a tool for steady growth. To remember that real wealth is not measured by how fast it grows, but by how long it lasts. You cannot control the markets. You cannot silence the noise. But you can control your discipline, your patience, and your courage. You can choose to step back when others rush in, to hold steady when others panic, to focus on value when others chase hype. That choice, repeated consistently, builds not only financial security, but also character. So let this be your guiding light. Markets are storms, technology is the vessel, but you are the captain. Steer with wisdom. Trust the compass of timeless principles, and know that by doing so, you are not only protecting your wealth, you are shaping a future where stability, growth, and vision prevail. In the end, the digital era is not the enemy, it is a stage. Upon it, old truths are tested and new tools are forged. But the story remains the same. Those who invest with wisdom endure, while those who chase illusions fade. May you choose endurance. May you choose wisdom. And may your journey through the seas of investing bring you not only prosperity, but peace.